Everyone, welcome to our live Monday night webinars. Thank you for joining me today. My name is Dr. Uchenna James, pharmacist, badass stock options trainer. So thank you. We go live every Monday at 7 p.m. I'm here for you all. So use me or lose me. No, I'm just kidding. So today we're going to talk about Bullet Bear, we don't care. Stock option traders make money when the market goes up or when the market goes down. So thank you for joining me today. All right, let's get started. Bull, bear, we really don't care. Options traders make money when the market goes up or when the market goes down. Today we're going to be talking about the expected move. So if you kind of knew where the market was going to be heading in the future, will that make you a better trader? Will that increase the probabilities of your trades being successful? Of course it would. Let me show you what I mean. So, I'm Dr. Uchenna James, pharmacist, badass stock options trader. Thank you for meeting with me today. We're going to talk about the expected move. Glad you're here. A few housekeeping notes before we jump right in. Drop your city in the chat so I know where in the country or the whole world you're joining me from. Feel free to drop a question in our chat at any time. I'm always answering questions live. You don't need to wait to the end. Grab a notebook. The ones who write it down are the ones who apply it. And we're in the application phase here. The replay is tomorrow. If you registered for the webinar, make sure you do that so I can send you a replay of our webinar session. What's up? Today we're going to talk about the expected move. Thank you for joining me today. Who's teaching it? Who's that beautiful young lady right there? That's me, Dr. Uchenna, pharmacist, trader, educator. I wear my hats on those titles, and I'm here to serve you. So thank you for taking out your Monday to be here with me. I'm so excited, hoping I can serve you at the highest ability. So I'm the founder of Dr. KJ Trades. We teach women how to achieve financial independence by trading stock options. I trade the same setups I teach. No theory, no gurus. You follow what I say, it's the same thing I'm doing every single day when I'm in the market. What are you going to walk away with tonight? 3 things I want you to leave this room knowing. What the expected move actually is. The single number professional traders check before every trade and how to read it. How to calculate it in under 10 seconds. Not playing with you guys. This is it. I hope you signed up for today's webinar because it's going to be fire. And then the 3 strategies to profit in any direction. Remember, bull, bear, we don't care. Options traders make money when the market goes up or when the market goes down. How I trade. Make money when the market goes up or make money when the market goes down. Tonight, I'm going to show you the numbers that makes this real. So what is the expected move? The expected move is just the market's own prediction of how much the stock will move either up or down. So in either direction. It's an implied range for a stock over a set period of time. It comes straight from the options prices. No guessing, no opinions, just math. It gives you a directional range, not a directional bet. Read the expected move, and you can trade the setup instead of chasing the story. So what I calculate every single Friday for the following week is the expected move of the SPX. It's the index fund that control 500 shares, follows obviously the SPY. It controls 500 shares of stock. It controls it controls 500 stocks in the SPX index fund. So on Friday, I always calculate what the following week's expected move is going to be, both up and down. So what I calculated was the SPX for this week's high was 75.36. For this week's low was 72.87. Let me show you how I got those numbers. And make sure you guys are summoning the best of who you are every single day. Okay, how to calculate it fast. I have a full formula for you and the shortcut that I actually use. All the expected move is the at the money call price plus the at the money put price, and that's all your expected move is. Very, very basic. I'm going to calculate it right now so you can see what I mean. Okay. So maybe you've heard about this little stock called Google. Last week, Google had earnings. Okay. Look at what happened over Google's earnings. So what I have in front of me is a chart of ThinkorSwim, my trading platform that I use. The time frame that I have right now is the 1 year, 1 day daily charts. Okay. So on Thursday, when Google had earnings, I think they had earnings on Wednesday evening, but the market didn't. When the market opened on Thursday, Google dropped precipitously. Let's see how many. It was down from Wednesday's close of 341 to Thursday's opening of 321. So it's a $20 move on Google overnight. How much does Google normally make and move, and how do we find out this information? What you need to do is you need to go to the trade tab. Okay. So there's something called implied volatility that'll tell you the expected move of a stock or a ETF, exchange traded fund, over the entire year. So what I did was I looked to see after last week's candle when it dropped $20, I wanted to see what all the expected move was for the next week. Because if I can place a trade like a bull put spread underneath the low of where the expected move what is going to be for the following week, which is this week currently, then that increases the probabilities of my trade being successful. So let me show you exactly what happened. Google dropped down to 321. I placed a bull put spread. I bought the 305 and I sold the 310. And right after earnings, with a drop like this, the premiums were so right. So this is where I put my bull put spread, something like this. 310 is the one I sold. 305 is the one I bought. Mind you, this was on Thursday. I've closed it today with an 80% gain. When you have the expected move, when you know those numbers, it allows you to calculate the future price of where the stock could go. How do we do that? So let's do it for next week. Today is Monday. So we still have Tuesday, Wednesday, Thursday, Friday trading days. I usually like to calculate this number on Friday for the following week and on Thursday to see if I want to put any maybe 1-day trades on. So today's July 31st. These numbers are important. This $11 is the calculated expected move based upon the implied volatility for Google for this week expiring in 4 days. How do you calculate that? You need to use the at the money. So right now, Google closed at $326.57 for today. So in between that, the at the money price is going to be about $325. So if I circle the at the money put and the at the money call. So that is the price. $6.30 plus $4.50. I'll show you the math. 6.3 plus 4.5 equals 1080. So what they're saying is that the expected move for the rest of this week, Google can go up or down $10.80. Very close to this $11, okay? So if you don't have time to calculate it, even if it only takes less than 10 seconds to add two numbers, you could always use, or if you maybe have another platform that this expected move is not on there for you, that's why I love ThinkorSwim. You can calculate the at the money ask price, calculate for the expected move, the at the money ask price plus the at the money ask price for the put plus the at the money ask price for the call. That total will give you the expected move. Do I need to repeat myself? Here it is. If you want to know the expected move, what you do is you calculate the at the money ask price of the put, add that to the at the money ask price of the call. Those two numbers together will give you the expected move for whatever expiration date you're looking to trade. Okay? So right now, Google has 4 more days to expiration. That will be the expected move for the next 4 days, expiring on July 31st. Okay. Now, why is this number important? Now, let's say I can put on a bull put, which is a bullish strategy, or a bear call, which is a bearish strategy. And like I showed you before, remember, when Google dropped $20, that was way outside of the expected move. So the odds of it keep falling past that expected move is a low probability. So I set up my bull put spread underneath that expected move. It got filled today at an 80% gain. Cha-ching. Just by knowing that expected move. So where do you find it on the platform? You can open up ThinkorSwim, open up your market watch, go to quotes and add the implied volatility column on to your quote column. I have that right here so you can see the way it looks. Let me show you how I got that. Go to Market Watch here. Then you go to quotes. And this is all the information that you can customize on your own per your watch list. So right now, this is like roughly a watch list of the semiconductors. If I want to see how that particular sector is doing, I can have all the quotes on here. What is the 52-week low, 52-week high? And if you want to amuse yourself, put some semiconductors in this quote list and see what the 52-week low is compared to the 52-week high. It's crazy how much money you could have made or lose if you're on the right or wrong side of that semiconductor trade. So if you add the implied volatility study to your quote, this is the expected move for the whole entire year. So if you want to break that down, you just divide whatever date, like you're 7 days out, if that's where your expiration is, by 365 and take the square root of that. If you don't want to do all that math, to find the expected move, you need to add the ask price of your put of at the money plus your at the money ask price for your call. That is your expected move. Okay. So, what I like to do is I always just draw it into my chart so I can see the range. If the stock trades outside the expected move, that's the edge. Either an overreaction or a setup shift, like what happened in Google last week. Love it. So here's 3 strategies that really don't care about direction. First, we have the long straddle. A long straddle is when you buy an at the money call plus an at the money put. A long straddle is when you buy an at the money call plus an at the money put. You need the stock to make a really big move to cancel the cost that you paid for that call or that put. If the stock does nothing, you lose money. So it's best to do this type of strategy when? Right before earnings. Because we already know that when you have earnings, it's probably going to make a big giant move. So that's when you want to put the straddle on. Or you could put a long strangle. So what is a strangle? When you buy an out the money call and an out the money put. It's cheaper, but it's still directionless. It's cheaper than the straddle, and you also need a bigger move because you bought it out the money. And of course, as an option trader, in order for your option to make money, you need it to go from out the money to in the money. Okay. Or you could do an iron condor where you sell an out the money call spread and an out the money put spread. On this particular strategy, you need the stock not to move. So you need it to stay within your short strikes of your call spread and your bull put spread. Okay. You make on your iron condor, you make profit when the stock stays inside the expected move. Whichever one you use depends on your view of volatility, not your view of direction. So your action before next Monday. Homework I actually want you to do, don't skip this. Pick 3 stocks with earnings or some type of catalyst this week and calculate the expected move. Then see what happened after earnings. Did it go outside of your expected move limits or did it stay flat? What strategy did you put? I want you to use the at the money straddle shortcut and check to see what happens. Of course, put this in your paper trade, and this is not investment or, financial advice. This is just for education purposes. So what actually happens after the event? The stock stay inside the range or blow past it? Make sure you journal every one, and this is how you build the read. 3 things to remember. The expected move is the market's prediction, and it's always in both directions. The fastest shortcut to getting that equation is the at the money call plus the at the money put. This is equal to your expected move. You don't need to know which way the market goes. You need to know how far it can go. And that's why we need the expected move. Drop your questions in the chat. And don't forget to like and subscribe to my page. If you want to go deeper, you can join me in my 4-week stock options mastery training course. Everything you know to place your first or your best trade with confidence. Or if you want to be in my corner for the next 12 weeks, these are for the women who want the system, not just the information. Join my 12-week private coaching program for $4,997. 18 plus hours of one-on-one coaching, my eyes on your trade every single week. Remember, the fastest path to mastery is through coaching. I'll see you next Monday.